I'm not though. But anyway, Keith, welcome back to F.A.C.E. Great to have you. I don't know how you got out of the rotation. I love your work. Waiting to hear you say hello.
Hey Dale, good morning everyone.
Hi.
How's everyone
Hi,
doing?
Keith.
Good.
Yeah, it's been what's it been, about a year or so, Keith?
I think so. Has anything happened since we've been away?
Good one, buddy. You want to share your screen? Yeah,
Let's see.
we've had it's a green box.
Let's see. I was just going to do a video. I don't have a pitch book put together for you this morning. I thought we could just
Okay.
talk through some things.
Okay. All right.
Um,
Do you want to use your video cam, or you have a pandemic haircut like me?
Here we
There
go.
you go.
Good.
Okay,
How's
Keith.
that? How do I
So
look, everyone?
yeah, I could run around to the different markets. Where do you want to start? It's been a long time since you and I have talked. So I'm curious. We were talking about that. It was over in the bond market, and really, the bonds have been poor performers. I thought Friday's standout was the reaction in yields on a very weak number. Yields still ticked up, so to me that was a standout. What's on your radar? What markets are you focused on right now going into the fall?
Yeah, well, at IceCap, so we're a global macro firm. So, 10 years ago, I launched IceCap, and global macro wasn't that cool, so to speak. And it seems like, increasingly now, every year, quarter, month, people are starting to, figure out that things are a bit odd out there in the investment world. So for us, Dale, we're constantly monitoring all markets. We'll go through a number of things that we find really interesting right now. But probably the
Okay.
number one item that everyone should be looking at now, it's really volatility markets. And I know most people think about the VIX when they think volatility, but you have VIX measurements, across all the commodities markets, for example, certainly the
Okay.
FX markets,
Okay.
fixed income markets, you name it. And most investors today, they've simply become too complacent. So when you look at any long-term volatility chart, you would say, holy smokes, so for example, if you're looking at FX volatility, so say US dollar, euro, or CAD, Aussie dollar, yen, everything is now at record lows. If you look at it
Yes.
across, say, commodity markets for, say, oil or gold, you're seeing the same thing. Credit spreads. I think everyone watches equity markets all the time, but the fixed income world is where they really should be focused. We've been talking quite frequently now that I like to say that the global yield curve has been suppressed by central banks. So whether it's through bringing short-term overnight rates down to zero or negative in some markets by using QE, for example, but credit spreads have followed them all the way down. And then, of course, over the last 18 months since the pandemic started, we have an enormous amount of capital just flowing into all markets. And it's just creating this moment where complacency has really placed most investors in this situation where they just have no idea what's about to happen. And when it happens, it's going to create some pretty dramatic moves
What
in
is
the
it?
marketplace. Well, like give an example. So, for example, over the last 20 years, really, we've now had three market events in the equity world. We had basically, 40 to 50% drawdowns. So, going back to, a lot of people remember the 2000 market break and the tech bubble. And then, then we're looking at what happened in 08, 09. And then, of course, just back in March of 2020. And the reason that's important, institutional investors, they don't care too much about it. They live in a relative return world. They think, that's fine. They have an infinite time horizon. But most investors are not pension funds. They're not endowment funds and so forth. So if you take a big drawdown when you're getting closer to your retirement age, it takes a long time to claw back. So, for example, for the 2000 and in 08, 09 corrections, it took investors, some of them, anywhere from 6 to 10 years to get back where they started. Of course, the March of 2020 correction, because there's so much money gushing in, from our central banks. That recovery was a lot quicker. But we point this out because there is going to be another market event, and we do not think it'll come from the equity world. Equity markets will move as a result of it, but it will happen. And there's just so much complacency out there. A lot of investors, again, they're going to get pushed off sides.
Where's it going to come from? The corporate debt market, all debt markets, Keith? I mean, I looked at, I'm doing a F.A.C.E interview on Face with you right now. So I have to show I really need a haircut. I'm going tomorrow. Anyway, listen, so everyone is, concentrated on everything's been going up, right? You're long the world. You have crypto, you have equities, you have certain commodity markets. They've cooled a little bit recently. What is and it's not going to start in equities. I have to guess it's interest rate related. Is that the surprise that the market's not prepared for? Not just a drift up in rates, but kind of maybe an out of control rise in rates. What's gonna pop the bubble in equities?
Yeah. So, for example, we expect the next market where we often refer to as risk will re-escalate. That's a calm way of saying, hey, it's going to get a bit funny out there. However, we view it as that happening in the emerging market world.
Okay.
So you could have a specific country event or specific region. It could be the bond market, for example. We've looked at Turkey quite a bit over the last 9 months. But if once we see an event where it becomes risk off, and then here's the key, Dale, you get foreign capital leaving a market. And so think of the world, you have emerging markets, on the perimeter, and then the US is the core market, overnight treasury markets. Money, it flows into the core during bad times and back out during awesome times. The point is today, we are going to see this event. And because central banks in the Western world are, they're so strong, powerful, short-term rates are not rising, by the way. They are not going to go up based on a policy decision or event. Instead, it's the long end of the curve. That's where the real risk is. Okay. And as well, people following this closely, they'll say, hey, the Fed is doing a lot of QE. They're trying to hold down the long end. And that's true. The Europeans have a complete lockdown in the Eurozone region. However, they don't have a lockdown on credit spreads. They don't have a lockdown on long rates in the sovereign debt market. But as soon as we get one event anywhere offshore or the emerging market world, funny things can happen. So as an example, we're a Canadian firm, by the way.
Yes.
I think you have a lot of, I imagine we have listeners here from all over. I'm hoping some Canadians on as well.
But we're all loonies.
Yeah. So we have an election coming up here now in a few days. And, it should get a lot of attention, on the scheme of things. Isn't, the policy or the mandates for each party, they're really wearing a different color shirt in some ways. It's not a big difference or deviation. However, it is attracting a lot of attention. And then when you look specifically at the Canadian market, for example, it is a good way to view the world. Everyone in Canada right now, you realize, hey, we made a lot of money in our houses. House prices have gone straight up. And people say, oh, it's because, you always want to buy a house. There's not enough supply. Demand is so great. And foreigners really want to invest in Canada because we're such a great country to live in. So we have a bit of a different perspective on it. Instead of thinking that, hey, foreigners, they really want to invest in Canada, instead you need to look at it and say, okay, why is Chinese money coming into Canada? Why is Middle East money coming in Canada, or Russian money, and so forth? Instead, you flip it around. You ask the question, why is that money leaving China? Why is it leaving the Middle East? Why is it leaving Russia? Because they're running away from concern, they're running away from risk, they're running away from that event thing that we just talked about. So then you want to go to an economy or a country that is perceived to have, a pretty stable political environment and economy and rules and stuff like that. But when you get foreign capital running into any market, naturally you get, all of a sudden, demand is greater than supply, and it pushes things up. So the real risk with Canada, and you can use this for example, for the Australian housing market as well, or any other one around the world.
US?
In the US as well, as soon as we get a spike up in long-term rates, and it's sustainable, That's when it becomes a grind. Then to fund your mortgage that's up for due for mortgage renewal. Canadian mortgage rules are different than the American market. All of a sudden, countries, governments, when they had to roll over the debt, they're no longer borrowing at say 1%, 1.25. Now it's at 2.5%. Or we look at what happened to Spain and Italy back in 12 and 14. It went from 4.8 to 12, overnight. But
Yeah.
these are the type of events where people in equity markets that they're not looking. They're looking at, hey, equities are great. Valuations don't matter anymore because money keeps flowing in. But we are likely going to have this external market event happening, and then that's going to push other markets off
So
sides.
are you a proponent of the milkshake theory? That this is going to, if it's an emerging market problem, that ends up really giving jet fuel and the dollar a boost, which is deflationary, and we get a huge move to the upside in the dollar because it's become a safe haven instead of the most hated currency on the globe.
Yes, the potential for the dollar to surge higher is quite high. But think of it though as, it's not something that's linear. Nothing in the investment world is linear. It's going to go in big cycles and in secular movements. So in our mind, you're going to have, the emerging market FX world, something will pop there first. And then the next market that's in trouble will be like CAD, Aussie, Kiwi, Sterling, stuff like that. Then you have euro and yen. And then, by this time, everybody in the world, they want to hold dollars. Remember a few months ago, everyone was talking about crypto. So my
Right.
mom, who's not an investment
Yeah.
person at
She's
all,
in Doji coin.
she was asking me about the dog coin
Uh,
and
all
everything like
right. Yeah.
that. However, but think about the euphoria around that market, or the euphoria around say the tech bubble, and
Yeah.
whatever one you want to look at. We think there's a very high probability that will happen with the dollar as well. So, for example, and you're going to use like say the DXY level. The DXY is what, 93 this morning, I think here.
Yeah.
Just DXY shooting up to 98, 99. It just the world starts not to work very well. All of a
Okay.
sudden, you get a market event, it goes to 105, 110. That's what you're looking at, and pretty soon you figure out, holy smokes, the world needs dollars to survive, and there's just not enough of them out there, despite all the, sort of the mainstream media
Can
stories
you
that we
explain
see.
that to our viewers, Keith? Because people are seeing all the fiscal stimulus and everything the Fed's done, and it would seem like you would have a wheelbarrow full of dollars, and people would just, like in the Weimar Republic, just dump the currency and hold on to the intrinsic value of the wheelbarrow. So, can you explain to people why there could be or already is a dollar shortage in the face of the Fed and fiscally what we've done with rescue packages, et cetera?
Yeah. So first of all, what happened in Germany back in the early part of the century? They didn't get
Last
hyperinflation.
century.
The last, well, I think we're there. And
Look, they dragged me kicking and screaming into the 21st century. So
yeah, I know,
I
but
understand. All
that's
right.
that's or that's the vintage that I'm still living in. I was really cool in the '90s, by the way, and in the '80s as well. Uh, but with Germany though, and a lot of people that they don't quite understand is that hyperinflation happened in that market, in that economy, not because they were printing money. They printed money because they weren't able to borrow anymore. So they weren't able to attract any more foreign capital coming to the market. So as a
Okay.
result, they had to print money. So there's a big difference with saying, hey, if you're printing money, you're going to have inflation. Because if that was the case, I mean, the Europeans would be up to their eyeballs in inflation right now. Because they've been doing it more than anybody, since the 0809 crisis. And they can't get any inflation in their system, based on the measurements that you're using. Same thing with the Japanese, or the same thing. As long as you're able to continue to borrow as a sovereign state or nation or government, you're going to be, you can continue to roll over your debt all the time until it doesn't matter. And that's the big point here. Going with the whole dollar story, for example, and demand versus supply. Let's just use the U.S. as an example right now. There's been a lot of QE in the American system, and the same thing up here in Canada, and all that for matter. And people will mistakenly call that they're money printing. Um, Indirectly they are, but they're not really doing it. So a lot of people know this already, but if you don't know, this is what happens. The U.S. Treasury, they will issue Treasury bonds or bills. They're going to borrow money. The primary dealers buy it directly from them. So J.P. Morgan will buy it from the Treasury. J.P. Morgan then will immediately turn around and sell it to the Fed. But the Fed then, they do not give J.P. Morgan any money back. Instead, they'll credit J.P. Morgan's reserve account at the Fed. So the only way for J.P. Morgan to stimulate the U.S. economy, because of the QE that took place, is that J.P. Morgan then has to lend on the reserves that are in the bank, right, that held at the Fed. So J.P. Morgan, Bank of America, you go through all these guys. And what's really interesting, if you look at loan growth in the U.S. economy ever since the pandemic started, it continues to grow slower and slower and slower. At the same time, when QE is going up this way, same thing in the Canadian market, the European market, the Japanese market. So the point is that you can do all the QE in the world. You're not creating this hyperinflationary market. Now, at the same time, I'm sure there's some chuckles right now saying, hey, there's a lot of inflation out there right now in the system. So let's just talk about inflation real quick. How much time do we have, Dale?
We have some time. We have about
Okay.
10 minutes or so, Keith. And okay, so then is most of the inflation supply chain issues that will be resolved?
Yes, and mostly
No?
yes.
Okay.
So for example, back in Q1, you had the 10-year in the US go from around 70, 75 basis points up to 175 almost. And whenever you get any market move very rapidly, in a near vertical line, up or down, market estimates and expectations, they always overshoot. So back in Q1, all of a sudden I'm reading, oh, the 10-year is going to go to 3. And then the next guy says, no, it's going to go to 4. Or another guy says, you know what, this is just going to cause the U.S. government to just crumble overnight. Like they're losing control. As soon as you get that kind of a rhetoric taking place, and then if you look underneath the way the system was put together, then you can say, hey, wow, this is a great opportunity. So for example, shorting the long end of the curve back in Q1, that's where you made money this year. It's not being long equities. It's getting this call right. So back to the whole inflation story. A huge component of the inflation story is driven by the supply shutdowns. And we had the view back then. We wrote about it. I wrote a piece called Californication back in May, called IceCap Global Outlook. And we addressed this specifically. Say, hey, once the global shutdowns or supply chains come back online, you're going to start to see, some relief in the inflation data. And that's the way it's starting to turn, and the market turned that way as well in the bond world. However, our concern again right now is that, we'll start to see more shutdowns take place. One of the largest ports in China, they're now shutting down again. They're experiencing supply disruptions. And as soon as you get supply disruptions in any market, again, you go back to the supply versus demand, supply equals demand or minus demand. That's what really drives all markets, in a bit of a going to an extreme level. So at this point in time, if we continue to see more lockdowns coming up, which I suspect we'll see up here in Canada coming out in the fall, it will happen up here, and you can start to see some more inflation numbers coming through. But there's been a lot of policy errors taking place over the last 18 months, and it's irrelevant what we or you believe that policymakers should do. Instead, you have to look at and say, what are they going to do? And it's very clear central banks, they're going to continue to keep rates low. There's talk of them becoming a bit hawkish and with tapering right now. I suspect that talk will end in a couple of months. And, they're going to say dovish all the time. And governments right now, as long as they're able to continue to borrow at low rates, they're going to run huge deficits. So investors have to prepare that it's a lot of stimulus will continue to come online, and then something's going to get tripped up here in the marketplace.
Okay, so all this talk about starting a taper never even begins. Do we do a taper here? Does Lagarde start a taper? And they're having a meeting this week, the ECB. Are either of these central banks going to taper, which isn't exactly tightening? It's just not as much liquidity, not
Yeah,
as
that's
much
a good
bond
way to.
buying.
But
Yeah.
everything, it's really, it's the rate of change, right? So if we get a slower rate of change, then it is sort of less liquidity coming in. For the Europeans, the ECB has ruined their bond market. Their bond market and currency market and banking system has been completely ruined. They may try to talk about taper, but it is highly unlikely they will ever get to the moment in time where they're going to be able to taper. For the Americans right now, they're talking about it. They're going to try to do it. But just think what happened. I think it was in 18 when Powell first started raising rates. 1/4 point at a time.
Oh yeah.
The
Before
markets took it.
he got called on the carpet by Yellen and Bernanke, and they sang "Kumbaya" and
Yeah, but what
turned
happened though?
around.
The key thing though, when the Fed did multiple 1/4 point hikes, I'm getting my year wrong. I think it was 18. I think they were doing
Yeah.
it. Um, all of a sudden,
His first year of his term, he was a
yeah,
hawk.
but it started just sucking money. This is part of the milkshake theory that you were referring to earlier. It just starts sucking capital out of every other market in the world. Because all
Yeah.
of a sudden you can invest in the most. So people don't understand as well about the treasury market and T-bills especially. It is the only market in the world where you and I can take billions of dollars, throw it in the morning, and then take it out again in the afternoon and not affect the price.
Yeah.
So that's what the definition of liquidity is. You can do a transaction in and out and not affect the price. You can't do that in the
Right.
housing market. You can't do that mostly in the stock market. Forget about corporate credit markets, FX world. Move outside of USD and stuff. It's really tough. Housing market. If anyone's using the housing market as a way to store the wealth, they think they have liquidity. No way. Because the moment in time you want to sell, there's no buyer. And you get this huge gap down. So I think what will happen with the Fed and QE that I mean, they're talking about it. They want to do it, but if they are able to start to do it, it's just going to further perpetuate dollar strength, which just sucks the life out of every other market, especially emerging markets. But the bigger thing that's happening as well, Dale, in Washington right now, they're trying to push through this large budget.
Yeah.
There's a lot of reasons why.
Infrastructure, the first by. Do you think they'll get any of it done? In this political environment, do you think?
No, so right now, if you're for politically, I mean, we have some pretty big elections coming up in the U.S. next year.
Yeah.
You don't want to be the guy that said, "Yeah, I voted for this enormous amount of stimulus," because I'm running against you. I'm using that against you, and I'm going to beat you on the head with it all the time. So what's happening right now in the U.S. political world? You're looking around, and the economy's doing okay. Stock market is up.
Yeah.
Everyone's making money. Like, hey, these are fun days. I suspect you're going to need to see a correction in equity markets, like some kind of an unkind economic or financial market event. Then that will give politicians then a
Cover.
reason. Yeah, they'll say, "Hey,
Yeah,
we need to
because
do this again."
yeah,
So that's
because
another reason why.
their constituents will call them and complain because their portfolios are down 20-30%. And also, Keith, before you go, I actually have a news flash to share with you, and it just came across, and I now know when Powell is going to tighten. There he is. See that?
So it's
Jay
not next
Powell,
year then.
huh?
It's not
Jay
next year.
Powell announcing the first rate hike. And they say it really, the job of being the president ages people. Look at what's happened to Powell
I
in his
know
term.
it's
Anyway, I had to do that. Okay,
yeah, that's good.
you know,
But just to leave
wasn't
everyone
that
with
good?
though, spend some time on volatility markets, and I don't mean the VIX. The world is now perfectly set up to get a pretty strong reaction to an increase in stress, and we're not bare. So, for example, we can tell a pretty good story about what's what's wrong with the world and what's dangerous in the world. But don't misinterpret that as ice capping and bearish on equities. So we're at what we call like a neutral kind of weighting in our equity world. But equities will certainly come off when we get an event coming up. But you have to understand that the risk in the world today, it's not the equity market. There's always residual value in the equity world. As soon as the bond market experiences stress, then you get permanent capital loss. And permanent is permanent. It's gone. It's wiped out.
All right, I got to ask you. Then I have to bring up. I have to share my screen one more time, and you're an expert. Explain this to me, okay? I want to show you two charts, okay? I want to show you. Where is it? This. Okay, I want to show you. Let me get this out of the way, and you tell me, because I've been asking a lot of people, and it's about junk, and it's about investment grade. So here's the HYG, the junk, right? Pressing the highs. And here's investment grade corporates. They look like they're rolling over. Why is money flowing more into junk, which is a lower grade, higher risk instrument, than into investment grade corporates? Is it just because they get a better yield? Is that the reason?
Yeah. So for the uninformed,
like dumb money wants a higher yield, and they don't know the higher the yield, the higher the risk.
So I had this conversation with the Bank of Canada there a couple of years ago, and I said, "Hey, are you guys comfortable with socializing the bad debt problem?" To which they didn't really appreciate the question. So
okay.
However, but this is a perfect example of it, Dale. So think about the most conservative investor in the world. A few years ago, you were buying term deposits or GICs here in Canada. You were making 4 to 7% on it, and you were able to have your very comfortable lifestyle. Now, all of a sudden, with those same investment options, you're down to basically 0%. And that's where you are. So then your bank says, well, let me introduce you to the investment advisor. And they say, hey, yeah, we can get you 4, 5, 6%. That's right. Easy to do.
Yeah.
And they say, is it safe? And of course, the response is always, yeah, of course it's safe. Everything is always safe.
Everything's safe. Yeah.
So all of a sudden, though, you have the most conservative investors in the world. Now they have all their money tied up into high yield or junk bonds. Preferred shares are hugely popular up here in Canada, where they're buying dividend paying, equities with high yields on them. So all of a sudden you have the most conservative investor in the world. It doesn't matter if they're Australian, American, German, Italian, you name it. All of a sudden they have this full on with a risk on investment portfolio. And then you get that market event happening. It's pretty tough. So like, for example, March of 2020, there were a lot of really tough conversations out there where investment managers had with private clients, and some people were down 30 to 40% in a matter of days.
Yeah.
And granted, the recovery did take place. However, that's only with hindsight. So at the time, you had what's lost in the industry, and it's a real shame. Investors are people too. We really are, and there's very little sympathy or empathy for the private investor these days. And so we had the pandemic striking back then. People were concerned about everything from healthcare perspective, really social scare. Yeah. And then all of a sudden they look at their retirement portfolio and it's just whacked in half. And they're saying, I thought I was in the safest investment ever. So, now we're back to that moment again. Another thing to look at, I would look at credit spreads, and, HYG, J&K, I would look at as well, but look at credit spreads. And what was interesting, when equities were down a few percent there a couple of weeks ago, and then they started to recover, but credit spreads didn't recover. Credit spreads, were staying wide at the same level. So there's lots of clues out there. You don't need to be absolutely terrified of equities. However, be prepared for a down step coming up.
Why not buy some insurance? I mean, we buy insurance for our homes, fire insurance, not because we hope there's a fire.
Yeah, that's a great point. I mean, you hope you never have to collect on it.
Yeah.
But, there's lots of...
People say it's a waste of money now, Keith, to hedge your portfolios. Well, it's affecting my performance.
That's true. But what we're finding though, so we have new investors coming to us all the time. And all the investors coming to IceCap, they're engaged. They know things are a bit funky out there, or they really know things are funky. And then if you show how you're able to structure your portfolio and your investments so that, ultimately what you want. So I managed money offshore for a long time for some wealthy people around the world. They just saw the world differently. None of these investors were all invested in the equity market. All they wanted was consistent returns like this. They didn't
Yeah,
want that. They don't want that 2000 drop. They don't want the 08
yeah,
or 09 drop. They definitely don't want the March of 2020 drop. They just want this going.
yeah,
And there are still ways to achieve that because the way mathematics work, if you lose 50%, you need a
yeah.
100% return to get back to where you started.
Right.
But boy, there's a lot of euphoria out there these days. You go for a pint with your friend or a coffee or a walk, and everyone's
Yeah,
talking about, they tripled their money last week.
sure.
That means that it's,
Getting
that's
closer.
yeah, can be a bit concerned.
Okay, Keith. Well, thank you so much for your time and your giving spirit to come and share your views with us here and edify the F.A.C.E community. I appreciate it. And let's not let as much time pass between our conversations. And you could follow Keith is the best place to follow you on Twitter at IceCapGlobal. Is that the
Correct, that's
best?
fine. Yeah.
Is that and your website's the same www.icecapglobal.com?
No, it is icecapassetmanagement.com.
Okay. All right. Well, thank you. Good hunting to you, Keith. Great seeing you and having this conversation. And hope that all your decisions turn green for you and everyone else that you work with.
That's great. Thank you, Dale. Take care,
All
everyone.
right, Keith. All right.
Okay.
Thank you,
Bye bye.
buddy. All right, everyone. So you could join the team. You're welcome, people. Here's a comment from Anthony. Great interview, insightful perspective. Thank you both. People enjoyed this interview, Keith. So thank you very much. You could join the team in 13 minutes for the morning edge. And Happy New Year again to everybody that celebrates Rosh Hashanah. And we'll see if sell on Rosh Hashanah, buy on Yom Kippur works. And we'll see everyone tomorrow. Adios. See you, Laura. You're very welcome, everyone. Thanks again, Keith Dicker. Adios.